it turns out that Enron was not the only energy company to go super deep into telecom in the 90s. Did you know about this?
No,
Do
it's
you
got to
know what
be.
the other company is?
It's got to be some super smart midstream company. Who was it?
Yes, 100%. It's actually Williams. So
Oh, no way.
Williams was the only company outside of the major telecoms to own long distance communications infrastructure. They had about 11,000 miles of fiber that, get this, they installed in abandoned pipelines, oil and gas pipelines in their system that had been abandoned. They turned the dead assets into basically free right of way that they didn't have to dig up any dirt for telecommunications fiber lines, and built a telephone company inside of an oil and gas pipeline company,
Pretty
which is
brilliant, actually.
incredible. And they went on to play a pretty key role also in WorldCom, who's going to be one of our main companies that we talk about today. So, ready to do this?
Let's do it. I'm ready.
Let's go. In 1995, there was an engineer named Tom Sluka at one of the first internet service providers called UUNet, in charge of forecasting internet traffic to inform infrastructure investments. So his COO, this guy Kevin Boyne, he wanted to make sure that UUNet forecasts were aggressive enough for their suppliers to make plenty of fiber circuits and equipment and that sort of thing. They didn't want a shortage of inputs to constrain their ability to build as they needed. So Kevin, the COO, basically pushed Tom to make his forecasts as aggressive as possible. And in so doing, basically, they create this stat that becomes a meme for the entire telecom boom, which is that internet traffic was doubling every 100 days. And that's going to be kind of a recurring thing that we're going to talk about here. But when WorldCom, this kind of like gunslinging, fast-growing acquisition machine that was quickly becoming one of the biggest telecoms in the U.S., when they acquired UUNet in 1996, their CEO, this very charismatic guy, Bernie Ebbers, which is going to be one of our protagonists today, he started using that stat. So internet is doubling every 100 days to support internal capital budgets. And then the internal team started using that stat. And then, actually, it hits a big time when the CEO of AT&T, Mike Armstrong, against all evidence of their own network, but just kind of trusting that WorldCom wouldn't put this out there if it wasn't true, he starts using it. By 1998, this becomes gospel, and even the U.S. Commerce Department quotes the stat in one of the reports, which, of course, at that point, everybody has a free rein to use it. And so you have Wall Street analysts, you have consultants, you have other executives and bankers using the stat to justify the incredible amounts of capital that are being invested to build out lines. Internet doubling in every 100 days tells a pretty powerful story, doesn't it?
Right. Yeah. I mean, my read is that the whole market was really set up around this meme, and that it was true for kind of the early parts, the 94, 95, 96 parts. But then it wasn't at all true for really like the second half of the tech and telecom bubble. But people kept saying it like it was true. And a lot of the IPOs and CapEx spending and orders being placed were all predicated on this doubling because it was what WorldCom and others were telling people, but it wasn't true.
It wasn't real anymore. Yeah. And if you do the math, actually, it just leads to some incredibly insane numbers. And so, clearly, once it became a meme, people weren't thinking about it and they were just coding it. Here's where I want to start today, Matt. Because the telecom business is, one, it has changed so much over the years. So what we think of today as media and telecom is extremely different. It's completely different from the 1990s. I want to actually map out the market a little bit because it's a bit of an abstract idea, this idea of telecom. And from there, we can get into the story that we're going to tell, which is going to be focusing on John Malone, the CEO of a company called TCI and a bit of a legend, and Bernie Ebbers, whom we referenced a little bit earlier, who was the guy that built WorldCom into this gigantic acquisition machine. So, market structure. So I want you to picture yourself in 1994. Matt, you are probably in first grade. You just got home from school and you turned on the TV to watch your favorite show, Boy Meets World.
Oh, yeah.
Okay. So you remember that your mom asked you to call her at work as soon as you get home. And so you pick up the phone and you call her office, right? Everything you just did was enabled by telecom. So you can think of the market at that point in the early 90s as basically two independent highway systems. So one of them carries voice over long distances. The other one sends TV shows to your living room. And the history of these systems is pretty fascinating because on the one hand, if you remember your history, you probably remember that Alexander Graham Bell invented the telephone. And he also co-founded the Bell Telephone Company in 1875 to commercialize this new technology. By 1899, the company was operating under the name of AT&T. And then by 1913, AT&T was granted a natural monopoly by the U.S. government with requirements to provide long-distance service to other companies. And so, of course, they spent the next several decades trying to game that system, as any monopoly might, to make as much money as possible and to kind of deploy and retain control. Finally, in 1984, there was a big antitrust fight with a couple of other competitors that had emerged in the 70s, Sprint and MCI, and AT&T was ultimately broken up into a long-distance company that retained the name of AT&T and a handful, 7 local phone companies that would have regional monopolies, with the exception of an 8th company that was independent of the Bell system, GTE, which had basically built out different local systems in areas where AT&T didn't operate. So there were kind of gaps in the market. And so there was this 8th local company. But the market structure for telephony was basically that. You have one long distance operator competing with a couple of other smaller ones. And then you had 7 monopolies plus one that was independent of the Bell system that had divided up the whole system into regions. So you can almost think of these local monopolies as kind of the neighborhood streets to the long distance highway system, kind of the last mile, the copper wire that actually goes into your home. It was heavily regulated. There was no real competition. And so if you were in Connecticut at your house, your telephone company was, I looked this up, almost certainly a company called 9X, which was one of the regional Bells. So that phone call you just placed was through their system. And long distance became more of a commodity because there was price competition. It became all about volume and operating efficiency, while local phone calls were a monopoly. And so those companies were basically like a utility, kind of stable. They owned the customer relationship. It was a market bottleneck. On the TV side, so Boy Meets World coming to your TV, completely different system. So this is cable television. So TV signals historically, now going back into like the 70s and 80s, originally were transmitted through antennas, but then very quickly the market migrated to coaxial cable. And so they would dig up streets, they would lay down cable into your home. And these also became very local systems that were kind of pseudo monopolies. And so a municipality would grant a local franchise with kind of very simple economics. You had a company that would lay out a ton of capital up front to put these lines in and connect them to people's homes. And then they would charge you monthly fees for decades to earn a return while trying to keep, people from unsubscribing and trying to keep their operating expenses low. And, similar to the telephone market over time, the cable business started to consolidate as some of the better operators acquired the less efficient operators, and they aggregated the subscriber base and targeted economies of scale. And so companies like TCI, which we're about to talk a lot about here in a minute, companies like Time Warner and Comcast and Cox, Cablevision, they became pretty big by the early 90s, and they dominated the cable market. Also, by the way, in Connecticut, I think your TV probably was hooked up to a Cablevision system because they kind of owned that market. So you can check with your parents later.
Yeah, one thing I think that's worth mentioning here is just the evolution, really the revolution in communications that's going on alongside all these things. When coaxial cable was originally rolled out, the purpose of it was to get broadcast channels to rural areas that were, in between mountains and couldn't receive signals. And at this time, 70s and 80s, there were only really 3 channels that anyone had access to, right? It was ABC, CBS, and NBC. At that time, Johnny Carson was the big late night talk show host.
Yeah,
and
Tonight Show.
According to what I read, at the peak, 60 to 70% of people that were watching TV at night were watching Johnny Carson, right? So one of the things that studying the telecom side of this whole thing really brings out for me is that this was not just about the internet, right? This was about a complete revolution in the way that communications happened around the world, whether it be TV, phone, or personal computer. It's also interesting to look at this period from the perspective of just raw capital outlays. The coaxial cable rollout that originally brought broadcast networks into rural areas and then started bringing, all kinds of other channels and really opening up all kinds of communications to the home. In terms of how big of a rollout this was, so when you look at it on a chart, it's kind of easily a top 10 project when you include both privately funded and publicly funded projects. Pretty much everything in the top 10 is a telecom project, except for the highway system is the biggest one, alongside the recent wireless rollout and the nuclear build out. Pretty much everything else is communications related. But
Yeah, which, by the way, those other projects were longer too, right? This is basically a capital outlay over, I don't know, plus or minus 5-6 years.
Right.
And the
right.
highway system was like decades. The nuclear build out was decades.
Right. So this is just a massive privately funded rollout of infrastructure that I think is just worth calling out and here in the beginning.
If you think about the amount of capital and you start visualizing the market structure, which is so critical to understanding what happened and why it happened, then if you're going to put yourself in the shoes of like a founder or an entrepreneur, if you were, or an investor even, if you were going to compete, right? You've got long distance telephone lines. You can go there, but it's going to require a tremendous amount of capital. And so if you're an entrepreneur, you're going to have to figure out how to raise billions of dollars to get right of way, to dig up, dirt and lay down lines. Or you can go to the existing long distance providers that have already done that, and you can effectively buy wholesale capacity on their systems. And there was plenty of companies that did that. And so you can do that. You can start a company basically buying capacity on the system and reselling it to other parts of the market that have not been tapped yet. So businesses or even consumer markets in non-urban areas, that sort of thing. You can also start a cable company. So if you start a cable company, more than likely you're going to have to go acquire somebody who's already got a municipality franchise, or you're going to have to go find smaller municipalities that haven't granted a franchise yet and figure out how to navigate that local politics world and get one. You're almost certainly not going to be able to start a local phone company because it's a monopoly, so you just won't have access. And so that's basically all you can do. So if you're an entrepreneur or an investor, you're really going to do one of two things. You're going to start a reseller telephone company for long distance lines, or you're going to start or acquire a small cable company and try to acquire your way to a bigger business. Really, those are the two options. And so I think that is actually going to set up the way we're going to lay this out today. The story today is going to be two people that exemplify each of these strategies: the long distance telephone reseller and the local cable company. So on the long distance telephone side, we've got Bernie Ebbers, who we mentioned at the top. And Bernie was a former basketball player and coach from Canada, actually, that settled down in Mississippi and built a very successful business acquiring and operating motels, believe it or not. So he was pretty successful at this, just a small business acquiring, operating, motels. He got a call from a friend in 1983, and that call ended up being kind of the opportunity of a lifetime for him, because he ended up financing a venture called LDDS, so long distance discounted services. And it was a new telecom business designed to resell long distance service on existing telephone lines. And remember, he's just financing it at this point. But very quickly, the business goes sideways. Bernie ends up taking it over and saying, okay, I know how to run a business. I'm going to take this over. I'm going to turn it around and I'm going to sell it. And he does the first part. He turns it around. So after 6 months, he's generating free cash flow. But instead of selling it like he wanted to, he doubles down. So he decides to double down, and he acquires a bankrupt reseller in Tennessee. And it's the first acquisition of many that will eventually lead LDDS to become WorldCom, the second largest long distance telephone company in the US, after AT&T, by 1999. That's our first character. The second character of the story on the local cable side is the legendary John Malone, who, by the way, is one of the few people with an investment track record that you could probably say in the same breath as Warren Buffett. Very different style of investing, but just a master capital allocator. John Malone actually started his career at AT&T. So he joined Bell Labs in 1963 after studying electrical engineering at Yale, And then while he was at Bell Labs, he got a PhD in operations research at Johns Hopkins. And Bell Labs at this time is like the kitchen for pretty much every major technology that revolutionized the 70s, 80s, and 90s. The transistor, right? Unix comes out of Bell Labs. So it's like the epicenter for a lot of stuff that comes later. He then spent a bit of time at McKinsey and a company called General Instrument, where he met a customer of his based out of Denver called Bob Magnus. And Bob had started a company called Telecommunications Inc., or TCI. And at this point, it was a publicly traded company. And Bob makes an offer to John Malone that he probably should have refused because he had a couple of other offers. I mean, at this point, John had been running a division within GI. He was a very successful, leader of the company. He was passed up for CEO of GI, which is why he was looking for other opportunities. And Bob makes him an offer that's basically like, look, come run TCI, help me save it from its bankers because we have a big debt load. Bob had been on this acquisition spree of other cable systems. They had too much debt, but, it was the 10th largest cable company at the time. And so John basically goes out and meets with these guys, with Bob and the team. And in his new book that just came out a couple of weeks ago called Born to be Wired, he says, quote, "There is such a thing as a cowboy code, and they had it. You finish what you start, stand up for what's right, and take pride in your work. It appealed to me." So he actually ends up joining despite the offer being much lower.
Yeah, and that book, Born to be Wired, is certainly good timing for this episode. His autobiography written by John Malone came out this month, September 2025.
Yeah.
So, studying John Malone's kind of upbringing, and it really like, it's just a hard question of nature versus nurture, right? Like it's really hard to tell. He had kind of a mechanic tinkerer father that he went to a lot of jobs with, who kind of got screwed over by a large corporate, and that kind of gave John Malone a little bit of his independent streak. And then I thought, you mentioned that he got his PhD in operations research. I think it's worth highlighting that at Bell Labs, he was not a scientist, right? He was also in operations research at Bell Labs. And the way he described it in Born to be Wired was his job was applying math and science to maximize profit, minimize costs, and build wealth, which as we get to know
perfect.
As we get to know John Malone better, that is what he spent his whole career doing. He's kind of a master of capital structures and minimizing costs, and especially minimizing taxes. And then one thing that stood out to me about him too is I think he invented EBITDA, right? Like, did you come across that at all?
Yes, yeah, he is, which is so funny, right? Because you talk about him as a great capital allocator, and a lot of times people compare him to Berkshire Hathaway and Warren Buffett and Charlie Munger, who, by the way, hate EBITDA.
Right.
So yeah, I thought that was funny.
Right. I think the way I read it was like John Malone's invention of EBITDA was the first evolution away from income statement to cash flow statement, right? So it's kind of like, hey, net income doesn't matter for us. What really matters is cash flow. And EBITDA was kind of a stand-in for what eventually became, people started caring about free cash flow.
For somebody who loved free cash flow so much, he sure went on to build businesses that are valued on so much intangible stuff. Media businesses that go well beyond free cash flow.
Yeah, I mean, I think when you think about the cable company build out, and just think about all the factors, I think, and how legislation and policy is very much in the mix here. I think a major factor in the rollout of cable was the accounting of it all, right? And this kind of goes to the invention of EBITDA, where these cable operators were constantly reinvesting in their businesses, but the policies were one, they got really beneficial accelerated depreciation schedules, which made it so they didn't have to pay taxes. And then two is because they were all hard assets, they were very levered, lots of debt, but they had interest deductibility before taxable income as well. And so that's kind of what had John Malone pointing Wall Street towards EBITDA, was that these are different kinds of companies that have these really big benefits around accelerated depreciation and interest deductibility.
Yeah, I think he's a bit of a genius at seeing around the corner. A lot like Jim Clark, both have PhDs, both are engineers, both have the mindset of a systems engineer with a capital allocator. But I think John Malone, on top of being an incredible kind of see around the corner, organized, disciplined investor, he's also a really great, shrewd operator and an incredible leader of industries. One of the things that comes across when you read his book and you read other accounts of him, he clearly had the system idea of how to make sure that there's not crazy amounts of destructive competition. How do we figure out how to work together across the whole value chain, not just competitors in the cable segment specifically, but even programmers and media. He's just got this incredible ability to bring people together and get things done. So let's go back a little bit. Remember in the early 90s, the telephone and cable markets were largely separate markets with separate infrastructure. By 96, everything changed, and these two are going to start to converge. So the first big change is what we talked about in part one. By 1995, certainly by the time Netscape IPOs, the web had captured the moment in the same way that you can't open today a newspaper or an app without seeing something about AI. It was pretty clear at that time, 1995, that there was this promise of the web that was going to probably revolutionize everything. But I think the experience to that point was incredibly painful, right? So you probably remember the modems and the dial-up tones and maybe even yelling at like a sibling because the line was busy, they were using the internet and you wanted to use the phone or vice versa. And we were superimposing this new form of data onto the communications network that was not really designed for that. And so it was very limiting. But it was also obvious that this would open up a massive set of opportunities for new products and services and new ways of communicating and distributing information, which also meant that companies, entrepreneurs, investors were all scrambling to figure out how and where this would grow. And this is the same time period, 1995, when Tom Sluka at UUNet makes the forecast that we talked about at the top, that the internet traffic was doubling every 100 days, which is true in 1995, but it won't be true anymore after that clearly becomes a bit of a meme and goes on to drive, all the capital budgets of everybody else for the rest of the decade. There were other technologies too. There were a lot of advancements in fiber optics and digital transmission of data that increased the capacity of the existing infrastructure quite a bit. There were also wireless transmission, aka cell phones, and you probably remember your dad carrying a brick to work, one of those giant cell phones. So all that stuff is coming up and starting to take off. But in the midst of all of this, there was also a lot of momentum towards deregulation, right? So you remember, anybody who's familiar with the Reagan era and the Clinton era knows that whole, probably 15, 20-year period was all about how do we deregulate, get government out of the way of business and let business run. And so the U.S. government decided to try to replicate what they did in the long distance market when they deregulated in the 80s. And they saw a lot of success there, right? So they deregulated the AT&T system and they increased competition. That was actually quite a successful, policy approach. The logic was that by 1996, there's all these new technologies. The lines are blurring between cable and telephone. It's all data, right? And so the market is probably better off with less regulatory barriers and more competition, more innovation, better for the consumer. So this meant that the local phone companies might be able to get into the long distance game to grow revenue. And then the long distance companies might be able to gain control of that last mile and own some of the local customer relationships and have an end-to-end system. And then for cable companies, it might open up the ability to upgrade their cable lines and deliver internet and maybe phone services too. And so basically you had this idea that, maybe all these companies can start competing with each other, and this market, because of technological changes, won't be a natural monopoly. And maybe a single company can own every single service that you get and make it easier for you, potentially cheaper and more competitive across all the different companies trying to provide that service. So the policy goal was really more choice, more competition. The actual result, though, was a massive unleashing of capital and activity. The 1996 Telecom Act ends up being pretty ambiguous, but it does spark this massive amounts of activity and this rush to merge and swap assets and above all, build capacity, because everybody expects that demand is going to be infinite.
My read of the 1996 Telecom Act is it was 100% kind of a bellwether legislation, but the ambiguity of it actually was focused on the local part of the market. My read of it was not ambiguous for the long haul, the carrier, the part of the market that AT&T historically dominated. but it was very ambiguous and therefore very litigious in the local part of the business. The opportunity that companies saw was, okay, now we can compete all across the spectrum, and so the opportunity is to own the whole thing, right? To own from beginning to end, all the way into the consumer's home. But they didn't want to start with cable because the legislation was ambiguous. So everybody started with the long haul stuff, with the thinking that over time this will get cleared up, and then we'll go into cable. And so it was really the long haul area where you saw the massive overbuild and the massive taking of market share from the incumbents, versus the local part saw a lot less new entrants taking market share. But I thought that was an interesting takeaway, that the cable part of the 1996 Telecom Act ended up in court for like 5 to 10 years after, until there was real clarity around it.
Yeah, it also highlights a key theme that comes up across multiple industries again and again throughout history, which is that the last mile is always the most complicated part of any value chain. And so that tells you two things. One, trying to compete in that last mile, trying to build for that last mile is always really, really hard. But if you have assets that are delivering service for that last mile effectively, then you have a natural moat on your assets, and that's pretty valuable. So back to the story. So by 1996, the market had fundamentally changed, right? So now you had these two separate highway systems that were starting to be more compatible technologically. They weren't completely separate, or at least it was clear that they would sooner rather than later be compatible. And all the regulatory barriers to entry for new companies and for incumbents were, at least in theory, removed, right? Locally, not exactly removed, and there's going to be a lot of litigation to try to work this out. But at least in theory, there's this message out there that the intent is to remove them. And so people start preparing to try to compete and to try to integrate the whole system. And so right before all this, Bernie Ebbers over at LDDS, soon to be WorldCom, is doubling down on the telephone reseller market to build a business. So after they acquired the bankrupt long distance reseller in Tennessee, that was kind of his first acquisition, Bernie kept buying these tiny distressed resellers across the South. And the goal was to stitch together routes and aggregate customers. And it's all very unglamorous. It's all kind of blocking and tackling. Again, they don't own their own lines. They're just reselling on existing AT&T and MCI and Sprint lines. But it does turn LDDS from a very local, small discounter into a regional carrier with, millions of customers by the late 80s. And a ton of operating leverage, right? So they have all these fixed assets, which are the reselling capacity that they've contracted, and they need to spread that out across a bigger customer base. So they need to keep acquiring, and they need to keep more customers coming onto that reselling capacity, because the marginal customer is basically pure profit. And so they kept doing bigger and bigger deals. In 1992, they outbid some bigger rivals to buy a company called Advanced Telecommunications Corporation for about $720 million. So now they're at real scale. And then in 1993, they do a huge three-way billion-dollar merger with two companies, Metro Media and Resurgence, and now they have national reach, which means that by 1994, they were able to buy two really big companies that put them on the map as a major telephone carrier. One was IDB Communications, and that was about $1 billion deal. And the other one is from our friends at Williams. This is how they actually get real assets on the ground, a company called WillTel, 11,000 miles worth of fiber network. And now they're no longer just a reseller. Now they're a top 4 long distance carrier, and they're a real competitor of AT&T, MCI, and Sprint, which means that then by 1996, they officially changed their name to WorldCom, and they went big. They bought MFS for $12.5 billion in stock. That brings along the company called UUNet, which is responsible for that internet is doubling every 100-day stat. And then in 97, they do another huge deal. They merge with MCI itself, one of the major kind of original long-distance carriers. And it was the largest combination in U.S. history at the time, valued at about $37 billion. So altogether, in a single decade, Bernie Ebbers basically transformed this small startup and this little patchwork of telephone resellers into a global carrier that is now deploying billions of dollars in acquisitions and capital investments per year. And as impressive as that was, it also meant that he had bet the business on this cycle, this wave of market structure changes and technological development, and really this anticipation of a huge amount of demand for long distance lines to carry internet traffic, and a very aggressive forecast that turned out to be a bit of a meme. But he's promising earnings growth to Wall Street, right? And so he has to deliver, and he has this immense amounts of pressure. Their balance sheet's a bit bloated because of all these deals. Operationally, it's hard to integrate all these companies. So keep that in mind as we explore how this market is going to evolve.
This is a public company who's said publicly that we want to be the best performing stock in the telecom space, right? So very ambitious on the public side, making a lot of acquisitions. But I think the question of, what were the metrics that Wall Street was focused on at this time for these kinds of companies, I think is important, both when you're studying the history and just when you think about today. And so the thing that WorldCom was most focused on was line cost expenses to revenue. And as you read about it, it needed to be 42%. That's what
Ooh.
they had communicated to Wall Street. And anything materially different than expectations was going to make it so they couldn't achieve their goals.
Yeah, that's critical. That's going to come up again later as a core KPI of how this whole story is going to unravel here in a little bit. So WorldCom has now become a major company. They're doing great. And meanwhile, on the cable side, John Malone, after joining TCI, not only saved TCI from the bankers, but he became this sort of master of capital allocation and complexity. And so his driving principle was to own contiguous systems, cable systems, as much as possible to maximize operational efficiency. And remember, he's an operations researcher, so he's constantly focused on how do I make the system better and better and better. And so he constantly bought and swapped cable systems with other companies to keep taxes as low as possible, to grow cash flow, build scale, get better terms from channels and studios. But customer service wasn't great. And sometimes dealing with the local municipalities and kind of the sharp elbows of the media moguls was tough. But John Malone navigated all of it masterfully. And so by building relationships like we talked about and trying to catalyze collaboration in the industry for R&D and avoid race to the bottom competition, not just with cable operators, but with the media companies, by the early 90s, TCI was at the center of the internet, actually at the center of the information superhighway. And we talked about this a little bit in part one, but the vision for the internet in the early 90s wasn't surfing the web on your computer, right? It was interactive television. And do you remember who John Malone partnered with to build the set-top boxes for interactive TVs?
Silicon Graphics, baby.
Yeah, our man Jim Clark, who of course was like the visionary behind interactive TV before saying, this is all wrong and going off to found Netscape. Lots of overlap between telecom and dot-coms, and this is classic John Malone, constantly looking to invest in like strategic complements to the cable system. And then to drive a finer point, telephone and cable companies start converging in the 90s. And so in 1993, TCI and one of the regional telephone companies that had been split off of AT&T, Bell Atlantic, they tried to merge, but the merger failed. So the two markets just weren't quite ready for each other. There was this big culture clash. TCI is this aggressive, cable acquirer. Bell is this like stable monopoly, sleepy bureaucratic company. The FCC at the same time voted to reduce cable rates. And then the shares of Bell fell 20% after the announcement. So the shareholders of Bell are kind of skeptical that this deal is a good thing for them. And so the deal fails. And then it kind of opens up a couple of pretty hard to navigate years for John Malone. And so in 1996, Bob Magnus passed away. He left behind this mess of an estate that led to a huge fight between his then wife and his two sons. And that eventually got resolved in January of 1998, but he was very contentious. And in the midst of that estate fight, actually, none other than Bill Gates got involved. And through Microsoft, he backed a bid by Comcast to secretly take over control of TCI by buying super voting shares that Bob Magnus had.
It's Lord Sauron from last episode.
Yeah. So, after the estate fight was settled, John Malone was pretty beat up. Bob Magnus was a bit of a mentor, kind of father figure for him. And now he's gone. And he wanted to spend more time with his family. And so he starts looking for somebody to take over TCI. By 1999, both Bernie Ebbers at WorldCom and John Malone at TCI were kind of central cast players in the telecom boom. and both were about to go into major inflection points. So the future had finally arrived. Telecoms had been now laying down well over $100 billion of CapEx per year. And if that $100 billion sound familiar, it's similar to what big tech companies are doing today for AI and for data center tech. There was a lot of hype around the internet, a lot of companies being founded, a lot of traffic and people coming online. The only change from the original vision is that prices had come down, and basically the industry had built so much long distance capacity that the long distance pricing had actually started to come down. And so WorldCom, along with some of the other long distance carriers, were trying to keep their pipes full, right? And so they had overbuilt because you already put the assets on the ground. It doesn't cost you any more to, that marginal kind of bit going through your system or marginal call going through your system doesn't cost you any more really in terms of variable operating expense. And so you're trying to keep it full, which means that less traffic, you have to lower your prices to keep your pipes full. You're driving down prices for the whole industry. There's a huge amount of pressure on WorldCom to keep up with earnings. And so the question inside the company becomes, how do we show earnings that are in line with expectations despite our prices starting to go down? And, Bernie Ebbers, as charismatic as he was at sales, which this is true, like if you watch his videos or if you come across interviews with him, very charismatic guy. He certainly knew how to sell. He was also not a great receiver of bad news, is sort of what I gather from other interviews and from the book that I read. And he was the kind of guy that if you delivered bad news, regardless of whether it was kind of your outcome, you're just basically letting him know that something in the company somewhere is not going right. He was the kind of guy that might block you for a promotion just for telling him. And then meanwhile at TCI, John Malone was on the other side of the market. So long distance prices were going down. Long distance carriers needed exposure to the last mile to shore up their businesses to something that would kind of hopefully offset those prices going down. And so John Malone very shrewdly starts conversations with the CEO at AT&T, Mike Armstrong. And the way that he lays it out in the book is that Mike just got it. Like he got the vision, he got the concept of an integrated telecom company, and he got the changes that were coming because of the internet, and wants to position AT&T to be able to control this part of the market, but also to be able to modulate investments so that you don't overbuild capacity in an integrated system. And so because AT&T shareholders are used to this kind of very stable, reliable company with dividends, and TCI shareholders are more of the types that are focusing on growth and cash flow, John Malone actually suggested a bit of financial engineering with a tracking stock where they would merge, but the TCI cable assets would have their own separate stock so that the two types of shareholders could invest in the piece that they actually wanted to invest in. And with that in mind, they agreed to a $48 billion deal. And the intent is that this is a path out of this commodity trap in the long distance game for AT&T and into becoming that single provider that we talked about, post 1996 Telecom Act, that single provider of voice, video, data services, everything. So when you contrast WorldCom and what's happening at TCI and AT&T, on the one hand, you had WorldCom with intense pressure to just keep up with earnings. They're playing still in the long distance market where price was dropping. And you've got this set of executives, but especially Bernie Ebbers, very focused on empire building and keeping up with the story that they have told Wall Street. And then on the other hand, you have TCI, now soon to be part of AT&T, that had turned this hard-won local market power into an integration play with probably the most credible telecom company at the time, AT&T. And they're going to try to go form the best possible integrated telecom company.
One of the things I thought a lot about too wasn't just the juxtaposition of WorldCom and TCI, but also the juxtaposition of telecom versus tech. And to me, there were a couple big takeaways. One was these companies were financed completely differently, right? So internet companies were 70 to 90% equity financed. So we talked a lot of IPOs. The telecom companies were almost that much debt financed. So, one thing we're going to focus on a lot as we focus these dramatic market periods is there tends to be financial innovation around really volatile market periods and bubbles. And so on the internet side, I think the innovation there was really just retail access to equities,
Hmm.
through Schwab and E-Trade. On the telecom side, I think the thing that really enabled this, especially on in the cable world, was the high yield market, right? So the high yield market didn't
Yeah.
really exist until the 80s. The telecom market went from 2 or 3% of the high yield index around 1990 to 30% the high yield index by the end of the decade. Even if
Yeah,
it's
which is incredible.
15%, that's a huge increase in high yield issuance. Guess who the biggest issuer of high yield debt was in the decade of the 90s?
It's got to be one of these guys, right?
Yeah, WorldCom. WorldCom, biggest issuer of high yield debt,
Yeah,
which is
baby.
interesting because they were mainly in the long haul part. So the long haul guys were mostly investment grade, the AT&Ts and the Sprints of the world.
Hmm.
But
Yep.
WorldCom was kind of, I think they were a fallen angel who eventually became high yield throughout the decade. And TCI was also a top 5 high yield issuer for the decade. Another thing that really stood out to me alongside just these things were very differently financed is just the importance of standards bodies. The internet had this too. I think the reason that doesn't come up a whole lot in the study of the internet is that I think maybe the standards bodies for the internet weren't really run by the business people. They were kind of run by more academics. That might not be right, but you never see it. You never see the standards bodies mentioned when you study the internet. Versus, for example, when you read Born to be Wired, there's this standards body called Cable Labs that was really a key differentiator and really important part for the rollout of all this hardware, whether it's amplifiers or set-top boxes or fiber nodes or cable modem. They're putting out this open source standards for how all of this is going to work together and what the base level infrastructure is and all that stuff. And guess who the founding chairman of Cable Labs was?
Oh, I know this. This is John Malone,
John Malone. Yep.
the man.
Yep. And so, those two things really stood out to me as I was thinking about this. People tend to focus more on the tech side of the tech and telecom bubble. And the reason for that, right, is that tech ended up being 30% of the S&P index at the peak around that, and telecom was
Yeah.
13%. But these are really the same. As we're hearing, these companies are merging like crazy. Like they're really, and a lot of the tech companies bought the telecom companies, right? Like AOL, a tech company, buys Time Warner, a telecom company. And so I really think they should
Right.
be looked at in aggregate when you consider this is just a communications revolution. And so the fact that we're going to get to 43% market concentration between tech and telecom also, is just worth noting and thinking about the market today.
These two, I mean, telecom and .com are completely intertwined in so many ways when you start digging into both of them. Although the capital, like despite the percent crash that comes later in 2001 for the .com companies being bigger, I actually think the amount of capital flowing through the telecom side is just orders of magnitude more. And the amount of capital destruction, at least in the short term in the telecom side, is just astronomical. And now this is all going to go lay down the infrastructure that eventually becomes, the backbone of what we think of the internet today and enables, the next couple of decades worth of growth in the US. But just the negative returns on capital that you're going to see from these telecom investments is just insane, like negative 70, 80%. A lot of destruction in the near term. Back to the story here. So AT&T closed the TCI deal in March of 99 in an all-stock deal. And from day one, the integration runs into issues. So there are two very different businesses. The long-distance side of the business is decelerating. The cable and the local side is messy. And the easier, straightforward financial move that John Malone had suggested with the tracking stock for the cable assets actually got scrapped at the last minute. AT&T doesn't do it. I think part of this is AT&T basically saying to John Malone, like, we've got this. Like, thanks, John, but we've got this. The problem was that as that long distance market starts weakening and the synergies between TCI and AT&T are slower to materialize, AT&T stock actually starts to sag a bit, and it creates a lot of issues because now you've got these two shareholder bases that are not really looking for the same thing. And so you've created this investment security that doesn't have a straightforward market. Like the AT&T shareholders are not happy. The cable shareholders are not happy. And the guy who is the least happy of all is actually John Malone, because as part of his consideration, he owned a lot of TCI. As part of the consideration, he took all stock, and he's locked in for a couple of years as a director of AT&T and as part of the merger agreement. And so he is just seeing the value of his of his stock go down the drain, and he couldn't sell it. And so he actually sold a very small slice, I think, in March 1999. But the rest of it, he sees a pretty substantial decline of well over $1 billion in net worth because of this. On the other side of the game, inside WorldCom, around that same time, because of the same long distance price dynamics, prices are down 5 to 10% year over year. By October of 2000, WorldCom controller David Myers, there's this really dramatic scene where he gets the preliminary financials from his team, and they were going to miss Wall Street's expectations for earnings. So he goes, he grabs the results, he runs over to his CFO, Scott Sullivan, and he says, hey, I think we're going to miss earnings. And Scott basically tells him, this is clearly wrong. Like, you guys missed something. Go back and fix it. And they go back and forth. Scott eventually becomes very frustrated, and he says, look, clearly there's an error. You guys haven't been able to find it yet. We're going to be able to find it at the latest by next quarter. So just go ahead and change a couple of line items, line cost expenses specifically, the key KPI, and let's put out the financials, which is what they do. And in so doing, they actually recruit a couple of more junior employees to do this for them, who are all very uneasy. They do it, and they put it out for the first time in 2001. It was going to be temporary, but of course it wasn't. So now they become dependent on this. There was no error. The accounting was right to begin with and reflected economic reality. And so slowly this becomes a habit, and WorldCom started using accounting adjustments, fraud basically, to keep up with earning expectations. And this is gonna unravel really fast and really dramatically. But before that, back at AT&T, in parallel, the strategic drift starts to worsen a little bit when all of a sudden, immediately, this is like, I think 6 to 9 months after the TCI deal, AT&T basically wakes up one day and they see in the news that Comcast, the third largest cable company in the US, announces that they are bidding $60 billion for the fourth largest cable company, Media One. And so Mike Armstrong and the AT&T executive team say like, oh, we can't allow that to happen. And they turn around and bid $62 billion for Media One. They win the deal. They put themselves in a very powerful market position to be the single provider and the integrator of, everything. But of course, their balance sheet is kind of a disaster by this point. They have a lot of debt. Now they're integrating 2 major acquisitions in the same year. And, by late 2000 into 2001, the market is openly questioning this plan, and AT&T shares are down. They start considering breakups and carve-outs to try to reduce debt and try to get out from this operational hole. And Comcast actually turns around and makes a run at AT&T's cable business because they can see that AT&T is against the ropes. John Malone is still on the board of AT&T, and he's a little bit frustrated, obviously, because he has seen his stake come down pretty substantially. He doesn't get invited to the board meeting because at this point, he still controls another company called Liberty Media, which is technically part of AT&T, although they have already had conversations about spinning it out. And so there are 2 classes of shares inside of Liberty. He has, I think, like 10% plus or minus of the economic stake, but about 40% of the voting shares. So he controls it. And so he doesn't get invited to this board meeting. He ends up saying, like, if I'm not going to be a part of this discussion, then I'm going to resign early. He was going to resign anyway that year. He was going to step down from the board after his lock-in ended after 2 years. But mid-year of 2001, he steps down from the board of AT&T, and he kind of washes his hands and goes off to run Liberty. By this point, going back to WorldCom, though, in 2001, there's an employee that looks at some of the line expenses that he's being asked to change for financials, and he, being a good ethical accountant, says, no, this is wrong. Like, this is not how these should be accounted for. He escalates that he doesn't think this is the right way to do this, and ultimately gets reprimanded and fired. And the following year, in May of 2002, he actually gives an interview to the Fort Worth Weekly. And that interview ends up landing on the desk of WorldCom's VP of Internal Audit, Cynthia Cooper, who is, by the way, the author of a really great book on WorldCom. She reads this article. She's like, oh, okay, this is interesting. Like, we should probably start our audit earlier this year than normal. So they start digging. They start looking at all the entries, testing some of the adjustments that had been made over the last year and a half. And they find some inconsistencies that they take to their audit committee on the board. By June 2002, they realized that they're going to have to restate earnings going back a year and a half. And the company discloses it. They disclose that there's billions in expenses that were improperly capitalized. And shortly thereafter, David Myers, the controller, resigned. Scott Sullivan, the CFO, actually refused to resign, so he was fired. And shortly after that, in July of 2002, WorldCom filed for bankruptcy, admitting at first to $3.9 billion of accounting misstatements, which is huge. Eventually, this is going to grow to $11 billion. So, just a massive scandal. And to put it into perspective, part of the reason why we brought up Enron at the top of this episode is that Enron is also going through its own accounting scandal at the time. Both of these scandals are going to combine to lead to eventually what we know today as Sarbanes-Oxley, which is the bane of the existence of a lot of people out there. But part of the reason is because of all these improprieties in the dot-com telecom boom. And the worst off of all the characters inside WorldCom is Bernie Ebbers himself, who first appears before Congress in 2002, and he gets blasted by a lot of the congressmen on the committee. And then he got prosecuted by the state of Oklahoma in 2003. That leads nowhere. But the big event was a federal prosecution in 2004 that by 2005 had found him to be guilty of all charges, which included securities fraud and filing false statements. And Bernie's going to be sentenced to 25 years in prison, of which he actually only served 12. And he was released for health reasons in 2019. Ultimately, he passed away in February of 2020 at 78. So pretty terrible ending for WorldCom. Interesting to think about the counterfactual here. Like, had they just gone out to the street and told the truth from an accounting perspective, they probably would still be around. I mean, MCI is still around, which is the inheritor of WorldCom's assets, but slippery slope once you start trying to cheat your way to success.
Well, my understanding is that there was a year period where after WorldCom had initially made their accounting adjustments, where the market was kind of like, why is WorldCom doing so much better than every other telecom company? Right? So like, I think I read it as like in the quarter, around the quarter, when they started making the adjustments to meet the Wall Street estimates, like every company started to struggle because, there was an official recession in 2001 and you had the overbuilt capacity to begin with. And so this was just like, when I think about this fraud versus the Enron fraud, this just feels like stupid. Right? Like every other company was struggling in the same way. And you hear this all the time, right? Once you make that first sort of fraudulent move, even if it's small and innocent, it creates a snowball effect. The congressional testimony you mentioned, I'm sure there were a few, but there was one in particular where all the executives from WorldCom were up there and they got just lambasted by Congress for, I think it was about 4 or 5 hours. And for the whole 4 or 5 hours, all they do is plead the fifth. They don't give any answers.
Yeah. Right.
So the Congress says something, really aggressive and accusatory, and then they plead the fifth, and then they do that for 5 hours. It's incredible.
Yeah. What the federal prosecutors are going to do is that they're going to prosecute him in a bit of a mafia style where they turn everybody else on the case. And we saw this with SBF, with the FTX prosecution, where everybody else that was on the executive team in and around Bernie ends up becoming an informant to try to get a deal so that their sentence is lowered so that they can go after the big guy, the guy at the top, which is, in this case, Bernie. And then to wrap up the TCI story inside of AT&T, that went from like $11 billion pre-TCI Media One deals to about $65 billion. And so the company's debt got downgraded and the margin for error from an execution perspective was minimal. And they end up faltering because the technical and operational integration is not working as planned, much harder than anticipated, especially with the local cable systems that were supposed to be AT&T's path to local markets and to that big integration with the long distance system. Those local systems need a lot more capital and upgrades than anticipated. And also another key thing, in contrast to John Malone, who was this great industry system builder, Mike Armstrong is not that, and he ends up alienating a lot of the so-called cable cowboys, very different culture. And ultimately, AT&T actually spun off all of this. And so they sell off the cable business to Comcast. They also spin off their wireless business. and they eventually merged with SBC, and so they kind of combined two regional companies, and then that's the company that buys AT&T. And so the company that we know today as AT&T is actually the SBC merger that bought the AT&T Corporation and then changed its name because AT&T had a more prominent brand. And so AT&T today is not actually the legacy AT&T that we've been talking about from the 90s and the 80s, but it's SBC buying these kind of remaining assets from the AT&T that had to spin out a bunch of stuff in 2005. And John Malone kind of rides into the sunset with Liberty Media in 2001 and has been running that ever since. And, has executed a pretty brilliant strategy with it.
Yeah, the only thing I'd add to the story there was when AT&T levered up a bunch to do all those acquisitions, they used a lot of commercial paper, which is very short-term debt. There's a part in Born to Be Wired where John Malone's at a board meeting and he says, "Guys, we could go bankrupt." Right? Like I don't care if we're AT&T and we're investment grade.
That's such a great scene.
If we have billions and billions of debt that we're having to roll over every month and week while the market's totally collapsing and falling away, we're in big trouble here. And so one of the big takeaways for me in all this is on the telecom side, because it's hard assets, like the debt, you got to study the capital structures, the usage of debt, and interesting John Malone type deal structures and whatnot is a lot more common because you're dealing with physical assets versus the internet's.
Yeah,
the internet companies don't have that.
One of my key takeaways actually from this period is that there are a treasure trove of insights embedded in the 90s telecom cycle. And today we're just scratching the surface with the stories that we've told here. There is so much in terms of analysis and case studies and implications to understand not just this time period, but also what is happening today, what has happened in other time periods like the railroad boom. It is just so applicable. It's just, and it happens so fast and there's so much data around it.
Absolutely. A really important takeaway here too is just where is the capital going and what is expected, right? So in this case, you had enormous amounts of capital going specifically into the long haul part of the telecom market because they not only expected, but they thought in real time traffic was doubling every 90 days. And so just from a capital cycle perspective, and a lot of that capital was debt capital, right? So like, even though tech became much bigger than telecom did, my guess is the telecom was more painful for institutions. One, because a lot of the tech investors were retail. And then two is you probably had a lot of institutions who thought they were just holding like 5%, triple B bonds that were never going to lose any money. and then a lot of these companies were bankrupt.
Well,
yeah, to your point, like you got to have that holistic view of, what is technology doing? What is legislation doing? How are the business models different across the spectrum? Who are the players? One thing I think we're going to find, right, is there's going to be consistencies between the types of people you want to back. I think the thing that comes to mind, right, is Bernie Ebbers is obsessed with acquisitions. And I think when you see someone obsessed with acquisitions, you got to ask, like, what's the end game here, right? Like, okay, like what's going to happen if you don't achieve the end game?
To build on that, I think you have to differentiate between empire builders and capital allocators to try to figure out if somebody's acquisition obsessed for the right reasons or not.
Right. And I think one thing that we'll find, and it's definitely true across Buffett and Malone, is just the hyper focus on taxes. Right. These guys do everything they can possibly do to not break the law, but not to to defer taxes essentially for as long as possible.
Right. I would say too that the understanding the market structure, whether you're an operator, a founder, an investor, is so important to try to figure out where might value accrued? What are the pieces of the market that are commoditized, that are going to have race to the bottom economics? What are the bottlenecks, right? And what are the constraints that drive those bottlenecks? So you can figure out if you can play in those bottlenecks or somehow get access or control of them. And then, figuring out who the people are that are positioned to actually, benefit from those bottlenecks is so crucial. And I think it's, in a lot of ways, data analysis is easier than trying to look around the corner, because looking around the corner implies having a ton of context. And so you have to be in a seat like John Malone, where you're seeing so much of the playing field that it's not like you're actually predicting the future, is that that we're already there. It's just other people haven't put the pieces together because they don't have the pieces, but you do. Right. And that's a little bit harder because you have to be in the right seat.
I think something related to that too would be to study who the contract structures across the space. My understanding is that the long haul space specifically, And you and I saw this, for example, in like the Marcellus in oil and gas, right?
Mm.
When markets are super volatile and it's really unclear and there's a lot of unknowns, a lot of people want to lock in long-term contracts because of that, right? Because there's the unknowns. I'll be curious to learn over time is if that ever really works out, right? If
Yeah.
signing long-term contracts in these sort of nascent, super fast growth, super volatile markets ever really works out for the person who's now committed to shipping capacity on those
Yeah.
contracts.
Well, that's exactly how it's playing out right now in the AI space. Because what you're seeing is you're seeing these hyperscalers that want to build these giant data centers and deploy hundreds of billions of dollars. But they've all studied this period and they understand that getting locked into a long-term contract when you don't fully understand demand beyond maybe 36 months is probably not a good idea. On the other side of that contract, you have an energy company or a power company, both of whom need long-term commitments to deploy capital to build a power plant or a pipeline or, a producing field of natural gas to supply the power plant. And so right now, a lot of these data center projects are actually getting bogged down in negotiations around term. So it's playing out in real time and it's pretty fascinating to see it. Okay. Should we leave it there?
All right, good episode.
All right. Thanks, everybody. If you enjoyed this, the best way to help us is to share this with anyone you think might like it and to leave us a 5-star rating on Spotify or Apple Podcasts or both. And of course, to tune in for part 3 of the series next week. All right. See you soon.